Hello, everyone. Thank you for joining us. We're letting everybody kind of drop in here from the waiting room. I'm going to give them just a second and we'll kick it off. All right. Welcome, everybody. Thank you for joining us for today's webinar on simplifying your corporate tax planning, a virtual event that we're hosting today for 2.5 hours of CPE. To quickly kick it off about that CPE, to qualify, you must actively respond to all polling questions and stay on for the duration of the broadcast. If you're having trouble seeing the polling questions, submit your answers along with the date, time in the chat and/or email our Elevate team. We'll make sure you get those credits. Question or comments, please submit them in the chat box during the webinar. We will likely not answer them during the conversation unless very relevant, but we will make sure that our folks follow up with you directly after the webinar. Quickly, for the learning objectives, we're going to talk through various domestic tax issues, international tax concerns, and then also the impact of the new mobile workforce policies that we're seeing, as well as a number of other opportunities that are available. So for now, I will turn it over to David Sordello, who is our head of tax here at Armanino, to introduce our speakers for today.
Thanks, Debbie. Good morning, everybody, and thanks for joining us. You know, we used to have events and do things live. Now it's hard to believe that this has been going on for so long that everything's virtual. And I think a lot of the topics we're talking about today are relevant to the changing world that we're living in, both now and going forward. Obviously, the tax world has not slowed down whatsoever. In fact, in my 30+ years of watching tax, other than when there's been major tax legislation passed, that's happened a few times over that 30-year period, there's just been no slowdown at all of new regulations, new things, whether it's from a federal, state, or international perspective, that are popping up almost literally every day. For every one of those things, there's new interpretation, new issues, new opportunities, and new risks. And so we are, as Armanino Tax and beyond that within our organization, are really trying to stay on top of this, and hopefully we will continue to provide you all content and really a lot of good information and things to be thinking about as we move forward and continue to navigate. Obviously, in the next couple of weeks, we are going to have an election that is pretty monumental across all platforms of, I think, our lives. Definitely tax is not left out. For those of you who have looked at the Biden plan, if that were to happen in the election, there is some radical changes to the current tax system that the Trump administration has put in, tax rate changes, all kinds of different permutations to that really, is going to be, 4 years ago we did this, we've been trying to figure everything out and maximize strategies and tax rates and set companies up in the future, and that could get turned on its head. And even if Trump wins, he's planning to do Trump 2.0, and that'll lead to different opportunities and issues that there could be out there for our corporate clients and beyond. So, definitely something that we're going to keep our eye on. The state landscape continues to change radically. There are a lot more states and localities than there are the federal government, and so glad that we have Alex Thatcher, who's our state and local leader, on the call today. He's going to give you a lot of good insight around that. Darcy, who's joined us fairly recently, but a real powerhouse on sales and use tax, B&O tax, and a lot of different areas, is also going to talk on the state side. We have Dan Reif, who's going to talk about Section 382. I won't steal his thunder, but it definitely is an area that we've seen a lot of issues around lately with the low interest rates and other things that are going on in that area. Nii is here as well from our transfer pricing side. Our transfer pricing group and our international group with John Davies work very closely together and need to these days, because there's a lot of interaction between how things are priced between different countries and all the interaction with the new tax laws and VAT and everything else. So John and Nee will give you a lot of insights around what's going on today and what's changed. And lastly, but not leastly, we have Pete Klinger from our comp and benefits practice. With all the mobile employee issues and all the secondary sales and other things that we're seeing in the marketplace, incredible amount of IPOs happening these days. You would never think that all these things would be happening right before an election, but I think it just goes to show you that the market is in a strange place and people are a little fearful that if they don't get out now, things could change. So a lot going on. Again, I don't want to take too much time and steal their thunder, but I appreciate everybody joining and all the participants that'll do a great job giving you more insight. So with that, I think, Dan, you were going to take it away on 382.
You got it. Thank you, David.
I've got, Dan, I'm actually going to jump in here quick. We're going to kick it off with a polling question really fast for those here for CPE, and then I'll give it over to you. So first question is going to be very easy. What is the current corporate income tax rate? Hopefully we know this. Get those answers in. I'll close the polls in 3, 2, and 1. All right. Cool. Done and done. All right. At least we're paying attention. Well, hopefully it doesn't go above that 21%, but we'll kind of see what happens. So with that, Dan, I will turn it over to you.
All right. Thank you. Hello, everybody. Thank you for making the webinar this morning. As David mentioned, my name is Dan Reif. I'm a tax director at Armanino. I've been working in Section 382 for about the last 14 years plus. I started with Armanino back in October 2016, and prior to joining Armanino, I was with Ernst & Young, basically working in their Section 382 group in the transaction advisory services group, doing due diligence and other one-off type research and so forth. So as David mentioned, we wanted to kind of just highlight Section 382. We feel like it's a area that needs to be discussed or thought about, mainly because of the environment right now. As it's mentioned in the slide, the AFRs which are used to calculate the 382 limit are at their all-time lows. So we're trying to implore our clients to think about 382 and try to get the studies done so that you can plan accordingly. But basically, Section 382 in general applies an annual limitation on the use of tax attributes following an ownership change. So the ownership change itself, you have to go over 50% cumulative change in ownership based on fair market value. And it's kind of an odd concept in the sense that you're using fair market value. Most companies in the C-suites think of ownership on fully diluted or common equivalent shares. But that's one of the complications of Section 382 is you look at everything on a fair market value basis. The actual ownership calculations are the biggest piece to the Section 382 study. Those can take the most time. And there's actually 2 methodologies to use to calculate if you had ownership changes or not. One's called the full value method, and the other is the hold constant principle. So depending on the facts and circumstances of the ownership and how much the value is that's coming in, both methods can give you very different answers. So again, being able to have your ownership analysis done under both methodologies to understand where you're at is very important. And just in general, ownership changes pretty much always occur on the first preferred stock issuance. So for any companies that have done any funding and that funding is going to new shareholders, that first preferred stock issuance is usually an ownership change. And then there can be additional ownership changes outside of just the first preferred stock issuance. If you have another big funding round that goes to a brand new shareholder and that, value-wise gives them more than 50% of ownership, or a group of shareholders that gives them more than 50% ownership, that can cause ownership changes. And it kind of goes on and on. I mean, basically any transaction that deals with the equity of the company is a testing date, which requires you to test for an ownership change. So other situations are sales of stock by shareholders, recapitalizations, and obviously acquisitions. Anytime you have a stock acquisition, you're pretty much going to have an ownership change. And as mentioned, the ownership change is basically calculated on the equity value of the company immediately before the ownership change multiplied by a published AFR. And there can be positive and negative adjustments needed to be made to that equity value depending on the facts. And as mentioned early, right now the AFRs, the October AFR is 0.85%. Historically, these have been in 2%, 1%. We kind of had a rule of thumb back in the no more than a year and a half ago that kind of whatever the equity value of the company was, that's about the amount of tax attributes that they would be able to use under 382. With the way the AFRs are now, that rule of thumb has gone away. Again, using 0.85% is creating a very low 382 limit. On top of that, in December of 2019, the IRS published some proposed regulations that could get rid of the what's called Notice 2003-65, which allows you to increase your annual 382 limit for recognized built-in gains. What I've heard through the grapevine is that they might not finalize these regulations, but if they were to finalize them as is, this would be a huge decrease to the amount of 382 limit that you can use against your use for your attributes. So we'll have to see if they do that. I think with COVID and everything, they might not finalize the proposed regs as is. And I was hearing that a lot of comments went back to them that they still believe that the hypothetical recognized built-in gains is still appropriate. So we'll have to see what happens with that. But again, ownership changes in 2020. If you can plan for them or plan around them, it's going to give you more use of your tax attributes, which can at times be the biggest deferred tax attribute. So knowing your Section 382 position, again, allows you to do a lot of things. The first one is obviously when you have taxable income, you're going to be able to know, okay, I can use this and this to offset taxable income, or tax, I can use a certain amount of credits. The other side to it is, if you are going out for new funding, having the ownership analysis prepared allows you to do projections. You can kind of determine, oh, well, if I issue, this stock to existing shareholders, then I might not have an ownership change. But if I issue it to new shareholders, maybe I only issue them 5 million and that doesn't cause an ownership change. Or maybe you use debt instead of equity so that, that doesn't come into play so much into the Section 382 ownership analysis. So again, having your 382 position known for planning purposes going forward for funding, to me, is extremely important. Again, with the 2020 rates and, the need for funding probably being more important nowadays. Again, we're trying to tell everybody to really think about Section 382. The other side too is if you're being acquired. We just had a situation where a client went through an acquisition. They had their 382 study done about a month before the acquisition. We basically gave that to the buyer side. They went through it. No big issues, but we were able to help them increase the purchase price by about 14 million. There were other things that came into play in that, but them having that 382 study in their back pocket to give to the buyer side and say, this is where we're at, it just kind of gave additional value to the overall purchase. The last item, and this isn't just the last item, but what we have here is just correctly stating your deferred tax asset for financial purposes. Obviously, that's important for IPOs and public companies, but again, just having there are some other mechanisms that can be done for public companies to secure your NOL, and those are kind of what we call poison pills or charter amendments. Those actually make it so that the company can't or highly unlikely that it would experience an ownership change under Section 382. I think that's what I've got, David.
Awesome. Thanks, Dan. We'll jump into polling question number 2. So let me launch this here for you. Based on what Dan just said, when does a change of ownership occur? The first preferred stock issuance, sale of stock by shareholders, recapitalizations, acquisitions, or all of the above? And I know a couple of folks have joined us since we started. I will be providing the slides and a recording of the webinar following today's presentation, so you'll get all of this good information. Get those answers in. We'll close the polls in 3, 2, and 1.
And it's just that we are.
There we go. Perfect. All right. Next up, we have Alex and Darcy from our state and local team.
Thanks, Debbie. This is Alex Thatcher. I lead Armanino's state and local tax group. And as David said in the beginning, I mean, there has just been so many changes in the last 2 years, especially in tax, but especially with regards to state and local tax. In the last 2 years, we've seen the state tax landscape change in such significant ways that it's been probably the most significant changes in the last century, from the U.S. Supreme Court case of Wayfair and the impact of TCJA, the CARES Act, the significant state budget deficits resulting in various legislations like California's NOL suspension and credit caps, the changing landscape in the way in which we're doing business with the shelter-in-place rules and various employees working from home, and the not only change in economic nexus footprint, but also just generally our physical presence footprint. So our goal is to hit on a couple of these areas where there's that everybody should be evaluating, but also some opportunities along with those. And so when we talk about Wayfair, I want to introduce Darcy Quaker, who's our SALT lead in Seattle and also a expert in sales and use tax and Washington B&O tax and transaction tax. So Darcy, you want to give a little bit of background on Wayfair?
Sure. Thanks, Alex. Hi, everybody. Wayfair, as Alex said, it's been a monumental change. I equate it to rolling your wedding day, the Super Bowl, Christmas, and a presidential election all into one court case. It's that big for the sales tax world and beyond, which Alex will talk about a little bit later. So if you're not familiar with the Wayfair case, here I want to give you some background so that it really makes sense as to how we got here and what it means. So first of all, starting off, prior to 2018, for purposes of making sellers collect sales tax in states where their customers are located, but where the seller has no connection, no physical nexus, if you will. The United States Supreme Court back in the 1990s and before said, well, the test has to be that you, the remote seller, must have a physical nexus, and then this state can require you to collect and remit sales tax on your sales into this state. And a physical nexus is defined typically as having employees visit customers or prospects in the state, or maybe even contracted salespeople, or maybe you've got inventory in a warehouse. That would be a physical nexus, as well as an office location. And so that was all good. We were dealing with physical nexus, but then back in the 90s, we all know that Amazon started selling books over this thing called the internet, and then it took off, and people started buying more stuff over the internet. And that was really good for the internet, increased sales, and also because of this physical presence test that was in place, the sellers were not required to charge sales tax on their sales delivered into these remote states. And that gave the sellers a competitive advantage over a brick and mortar store in the local hometown because it cut off 5 to 10% off the sales price because they didn't have to charge sales tax. So that was good for the internet, but it wasn't good for the states because the states were losing billions of dollars of sales tax revenue because the sellers weren't required to charge it. And it really wasn't good for the hometown Main Street retailers either, because people would come in, touch, feel, look at their goods, and then go home and buy the same good over the internet and not pay sales tax. So states got together in a smoky back office room and they said, okay, we got to fix this thing. And so they pointed to South Dakota and said, South Dakota, you're going to fix this. And what they decided is that South Dakota was going to pass a law, which they all knew was illegal. And the law would say that in addition to this physical presence nexus test, there would also be a new test called an economic nexus test. And so this economic nexus test that they came up with is that if a seller in a remote state sold more than $100,000 of goods to customers in the state, and or 200 separate transactions within a calendar year, that is sufficient to make the remote seller subject to sales tax collection responsibilities. So they set up that law, they passed it, and then South Dakota went out and started very strategically auditing some of the big internet sellers, such as Wayfair and a few others. Wayfair got the name on their case, knowing that it was going to be a fight, because South Dakota knew that they were setting up this law that conflicted with prior U.S. Supreme Court rulings, but they wanted to test the court and see what the court thought.
Well, and Darcy, what's interesting there is they did it with confidence, though, because in an unrelated Supreme Court case related to disclosure of information for sales tax purposes in Colorado, Justice Kennedy, in a dissent, had invited a state to challenge the old physical presence rule through economic nexus, and so South Dakota kind of took the advice from Kennedy in an unrelated dissent. So there was some confidence that the Supreme Court would entertain an evaluation of a reevaluation of the former physical presence precedents.
Yes, that's great, great, and so there was some good hope by the states that they would win, but ultimately it was close. It was a 5-4 decision by the United States Supreme Court in the Wayfair case, and it was really interesting to listen to the justices during the oral arguments, where really they were diving down, trying to understand what does it mean, what burdens are placed on the seller if they are required to collect and remit sales tax. And counsel for South Dakota said, oh, don't worry, justices, it's really easy. There's all these tools out there. It's really easy to charge and remit sales tax. And counsel for Wayfair was saying, no, not really so easy. It's quite complex, actually. And you could hear the justices were confused. They said, well, is it easy or is it hard? You're telling us two different things. Ultimately, they sided with South Dakota, and economic nexus is now the allowed in South Dakota. That was June 21st, 2018, 7:32 a.m. I remember looking at the clock. I remember where I was when that happened. So South Dakota won, and immediately, either by law or policy, hook or by crook, the other states immediately jumped on board, and they too adopted economic nexus so that they could require these remote sellers to start charging sales tax. So then we had to start complying. And for the big companies that were already registered in a handful of states because they had physical nexus, they already had the infrastructure in place. So it wasn't that hard for them to add on another 10 states or so to collecting sales tax. But the challenges for the smaller and mid-sized businesses that really don't have any physical nexus outside their home state, and this whole concept of economic nexus is just foreign and odd, that they're still, to this day, 2 years later, still struggling with economic nexus. And Alex and I and our other partner, our whole SALT team, every day, we are having what I call the Nexus Talk with our clients to explain Nexus and why we need to really evaluate this. So the steps for dealing with this now, the first thing you need to do is what we call a nexus study. And that's where you go through and do an evaluation of your physical nexus for the prior 4 years. And you don't want to skimp on a nexus study because, you know, there are a lot of variables out there. For example, maybe you attended a trade show in a state. Well, that's sending a person into the state, but maybe that state has a specific exemption that if you go to a trade show for less than 3 days, that will not create a physical nexus. So there's a whole lot to doing a nexus study that you need to do to get the right answer. You
Yeah,
also
and Darcy, and also just to point out, you know, I think it's incredibly important to do it because, you know, nearly every state, well, every state that has a sales tax is going to require an economic nexus evaluation. And the thing is it's from a sales tax perspective, it's actually not a tax on the taxpayer itself. It's a collection obligation. So what winds up happening when we don't get our arms around collection and remission obligations and responsibilities, it turns what should be a pass-through tax and more of just a compliance burden to a liability on the entity. So to the extent that you're not in compliance and collecting and remitting, it becomes a tax that the taxpayer is liable for, plus penalties and interest. No statute of limitations is running. So there could be a lot of downside to ignoring potential nexus issues that really should just be a compliance issue as opposed to a tax on the taxpayer, given that it's a pass-through tax by nature.
Absolutely. Yes, that you're conscripted. When you decide to start selling things in other states, you are conscripted to be a collection agent, whether you like it or not. And if you don't do it correctly, there are severe ramifications.
Yeah, so this nexus study can really help get your arms around the compliance, and at the end of the day, mitigate a lot of potential unnecessary risk and liability.
Right. Now, just one word of warning about nexus studies. A lot of advisors out there are performing nexus studies, and many of them do them very well. But some of them, do nexus studies on the quick and dirty route. They don't dive into it as thoroughly as they really should, thus giving the recipient maybe a false sense of security, that they've got everything covered. And Alex is going to go into that because some of these providers, especially some that sell software, say, okay, we want you to know that there's a problem, so you'll buy our software. But they don't really go into the full nexus ramifications of all the other taxes. So it's really, really important that you do have a very good, thorough nexus study done so that you know where you're at. The next step is a taxability study. So it seems kind of backwards. At first you determine where you would be required to charge sales tax. And then step number 2 is, well, is the state where I'm selling into, do they actually subject my goods or services to sales tax? Seems counterintuitive, but you do it in this order because number 1, you have to take the entire approach holistically to make a complete evaluation. You can't just say that I'm only going to look at states where my products are taxable, because there's other ramifications, like maybe there's an attached B&O tax in Washington, where even if your products aren't subject to sales tax, you still have a B&O tax. So you need to do both steps simultaneously. And a taxability study, that is asking the question, are my goods and services subject to sales tax in the state? It sounds easy, but it's really not. I'll give you an example. Yesterday, a client called and they sell coconut water, and they wanted to know, is coconut water subject to sales tax in the various states? So we started talking about the taxability of water, which has some pretty clear guidelines in many of the states. Then I thought, wait a minute, coconut water is probably more like juice because it comes from a plant. It's not water, even though it's called water, it's probably more juice. So let's look at the taxability of juice. And sure enough, in some states, they tax juice and don't tax water or vice versa. So it really makes a difference, and you really have to dive down deep into what it is that you're selling so that you can make the determination about taxability. Then, once we've determined the taxability, and then we can calculate a potential liability going back for those prior periods where, oh, you've got nexus, your product's taxable, here's the potential liability for you as the seller. But then what we do is we start working our magic and say, okay, what can we do to reduce that liability? You know, let's look at who your customers are. Maybe your customers, if we go back and ask them, they'll give you an exemption certificate because maybe they're selling your product for resale. Or maybe your customer is a nonprofit organization that is exempt from blanketly from paying sales tax in a particular state. So that way we're able to help minimize the tax liability so that then you can make a good business decision about where you need to register. The next step then is, once you've decided that, is to register with the states. You can do this by voluntary disclosure agreements, where you can register and eliminate the penalties that are imposed for the prior tax liability, or regular registration. Again, make sure that you're getting good advice here. We've seen some of the consultants out there just say, well, you need to register everywhere. We think that it's better to have a conversation and kind of point out the pros and cons and let you make a good business decision, because by registering, then you're in their system, and that could trigger other taxes. It triggers ongoing filing obligations, which take time and money. So you want to really make sure you're making good business decisions about registering. The next step in compliance is, if you're charging customer sales tax, it's really hard to look, it's not hard, but it's time consuming to look up the rates at the location where the customer is located to determine the correct sales tax rate. And there are software solutions out there for that. So you want to make sure that you get a good software solution, especially if you are using an e-commerce platform. And we can help advise you on which solution might be the best for your business. Finally, once you've collected the sales tax, you always must remit every penny of tax that has been collected. It's a trust fund. You don't get to keep it, even if you collected it incorrectly. So you have to file sales tax returns and remit that tax to the state. And that, again, is a time-consuming and manual process if you do it yourself. Many companies choose to outsource that. Armanino prepares tax returns. There are also software solutions. We can help you advise you on what might be best for your company. The final bullet point here in the compliance is kind of off topic but interesting. That's marketplace facilitator laws. So what happened after Wayfair, and Wayfair started passing, or the state started passing laws to subject the remote sellers to sales tax, then the state said, wait a minute, a lot of these sellers are selling through a internet platform like an Amazon marketplace or an eBay or an Etsy or Walmart.com. And in those situations, we're still looking to each of the individual sellers' economic or physical presence nexus tests. Wouldn't it be great if we could just have the facilitator, the Amazon, collect the tax on behalf of the seller? And so in 2019, the states started passing marketplace facilitator laws, which will require a marketplace facilitator to collect the tax. Now, if you think government can't ever get anything done quickly, that was not the case with marketplace facilitator laws. These things spread like wildfire across the nation. Currently, there are only 3 states that impose a sales tax that have not yet imposed a marketplace facilitator law, but they have bills in place, and it'll probably happen in early 2021. So the states are saying it's a whole lot easier to go after the big fish than a whole lot of little fish. And that's actually helpful to many of the sellers if you're selling through a marketplace, because then the marketplace facilitator takes on the collection responsibility. But it also gets a little challenging because you need to communicate whether your goods and services are taxable, and you still may need to register and report those sales, even though the marketplace facilitator is actually remitting the tax. So, and then you also have to really be cautious about, are you yourself perhaps acting as a marketplace facilitator? You're going, no, I'm not Amazon. Well, the definition of marketplace facilitator is different in every state, but generally it involves a platform that advertises goods for a third-party seller and collects the money from a third-party customer and kind of just intermediates the transaction. And,
yeah, I mean, and Darcy, that's like I think that's a critical point where I think some of the unintended consequences of some of these marketplace facilitator laws, they all are different, but some cast an extremely wide net, and sometimes you know, the unintended consequences I think are somewhere where you can be a marketplace facilitator and not even touch the money.
Yep.
And so that's kind of where the net can be far more expansive than one might think. So if you know, you're a platform or have a platform, you know, it is kind of critical to take a look at this, because it can apply to what ones might not typically think of as a marketplace facilitator, because the definitions are very widely, and they can be quite broad, and also apply to like taxable services and things like, even things like platforms where it's you know, kind of like the Airbnbs of the world, but that would apply to, like, you know, vehicles or things like that, where they would be subject to a sales tax, but might not be goods because of the broad definition.
Exactly. For example, I was talking to an advertising company about 2 hours ago, and they said, oh, we're just an advertising company, but if somebody wants to order business cards, they can order business cards direct from the printer and just use our website. So, ooh, sounds like you are a marketplace facilitator, perhaps, for these business cards. So you really have to be thinking keep an open mind, remember marketplace facilitator, and really be careful, because again, if you are unknowingly acting as a marketplace facilitator, you could be held responsible for the sales tax that is running through your platform.
Yeah, and then it's also just the measure is the gross transaction base, and gross, you know, typically 100,000 can be triggered pretty quickly.
Right, exactly. You know, there might also be a planning opportunity in there as well. So I want to dig into that a little bit. Always where there's something bad, there's going to be something good. You just got to dig down. So we're working on that. Final point here. Working from home or beyond creates physical nexus. Well, I think almost all of us are sitting at home right now, and we talked about physical presence nexus creating a sales tax obligation for the seller. What if your employees are sitting in a different state as they are working due to COVID? You know, maybe they've just got a small apartment for themselves in a big city, but due to COVID, they've decided they're going to go work from their parents' large home in another state. And does that give the employer physical nexus? Well, most states many states have come out and said no physical nexus. Other states are kind of remaining silent on it. In fact, yesterday, I'm an advisor to the Washington Department of Revenue, and we had a board meeting, and we were talking about this. And I said, you know, it'd be nice if you came out with something specifically on your website to say that working from home does not create a physical nexus. And they said, well, yeah, we're kind of taking that position, but we don't want to put in anything in writing. So I think most states are understanding the situation, but the big question is, what happens as we come out of the COVID period? And different states are going to come out at different times of COVID. If you even look at the NFL stadiums over last weekend, some had people in the stadium, some did not. And so it's going to be different in each state. So just be cautious that what's working now and not creating a physical nexus due to the leniency of the states for COVID period. If your employee says, yeah, I really like staying in mom's basement and I'm going to work here for the rest of the time, after COVID, that actually might create a physical nexus in the future. We don't have a whole lot of rules or laws or guidance, but just be attuned to that, and there will be more.
Well, and that, that's an important, extremely important point too, to be kind of aware. And we are having these calls, seems like almost daily, with regards to employees working from home and increased physical footprint. And while, some states, like Darcy says, are, most states haven't really put out comprehensive guidance, but some states have put out some limited guidance, but the guidance tends to be pretty narrow, and narrow in focus in terms of that it's just for, say, the COVID period, which sometimes is not that clear either, but is limited to certain taxes. So while there may be, say, an exemption from corporate income tax nexus, or sales tax nexus, or withholding tax nexus, it's important to pay attention to how broad and how broad the nexus exclusions or are within each jurisdiction, because it is important to fully kind of unravel what those exemptions are, because they can, by having an employee in the state would likely create not only income tax and sales tax nexus, but withholding tax obligations and state unemployment tax obligations. So it's important to make sure when applying an exemption that the scope of that exemption is analyzed, because while you might be exempt from, say, a corporate income tax, there still might be some employee withholding obligations or other types of obligations, and also just to make sure that the policy, the work from home policy, is in line with that exemption. So to the extent that you, kind of like Darcy said, run past the exemption expiration date, that could create some issues too.
Great. All right, next slide, please, Debbie.
Yes, and as Darcy stated, Wayfair, probably the most significant state case in the last 50 years. And while it was a sales tax case, the interpretation of nexus in that case is all based on constitutional principles. And so states have, for years, really starting in 2002, have implemented various economic nexus rules for non-sales tax. So from a corporate income tax standpoint, or, like in Washington, the business and occupations tax, various gross receipts-based taxes, margins taxes. So there's been a litany of economic nexus statutes and provisions out there for decades. However, up until Wayfair, most taxpayers chose to ignore those, and most taxpayers chose to ignore those based on the principles of physical nexus. So to the extent that that the states were going to impose an economic nexus provision on a taxpayer, say from a corporate income tax side, that they would lose if it were litigated to the U.S. Supreme Court because of the precedence of physical presence. And the thought was, well, physical presence shouldn't be any different for a corporate income tax versus a sales tax, because it's all based on the U.S. Constitution and the Commerce Clause and the interpretation of that. And so what wound up happening, while I think the most overlooked kind of issue with regards to Wayfair is that it's not solely applicable to sales tax, because it does have applicability to all other state and local taxes, including corporate income tax, because what it does is it validates all the pre-existing economic nexus provisions that were, for the most part, previously ignored. And it's why Wells Fargo in the second quarter of 2018 had to put up a $500 million reserve related to economic nexus for other than sales tax. And it was because they weren't filing in a number of jurisdictions that had economic nexus provisions, where they then didn't have a position, because as part of Kennedy's majority opinion, he basically undid all of the precedents of Wayfair by saying physical presence had always been bad law. And by saying that it had always been bad law, it validates all these other pre-existing, unrelated to sales tax, economic nexus, or factor presence is also what a lot of states will call it, factor presence standards. So that's what's most important, I think, in doing these nexus analyses, is to make sure that there's not just compliance with the sales tax piece of it, but also from the non-sales tax piece or business activity tax side of it, which could include corporate income taxes, gross receipts-based taxes, and all the other types of state and local taxes. And there's a myriad of those. And it's also important for loss companies. I know we get a lot of clients where the thought is, well, they're just a loss company, so it would just be, just retroactive filings wouldn't really be create any exposure. It just might be a future opportunity. However, it is important because there are a lot of jurisdictions that would have gross receipts-based taxes. For example, Washington's an example of that, where they have economic nexus provisions dating back, depending on the type of sale, but 2010, 2015, 2017, based on economic nexus provisions, and lots of states that would have factor-based presence. So there could be, even for loss companies, exposure liability that's worth looking at, and the statute can go back much further than a Wayfair sales tax statute, given that those are all kind of post second quarter 2018. So when doing these nexus analysis, it is important, because the last thing we want to do is move forward with a VDA for the sales tax side of it, and then blow our opportunity to address what could be a more material non-sales tax potential exposure on the business activity tax side. So that's one thing too, because I think that at the end of the day, it's something you want to resolve altogether through the VDA process, like Darcy said, really kind of mitigating any potential exposures, which we're finding if we do it all together, we can really kind of mitigate any sort of past liabilities and exposure. And then in terms of what we're seeing is, just because of this cascade of relevance from a state tax side with Wayfair and tax reform and CARES Act, and the state budget deficits where we have like NOL suspension and credit caps, the planning and attention to apportionment is becoming increasingly relevant, both we're seeing from a planning standpoint, but also from the states really going after I guess, can you, Debbie, can you go to slide 14? Yeah, and so I think so where there's real opportunity to for savings is to really dig into apportionment, and given that the nexus profile is so much more significant than it has been, and the state effective tax rate, given the lowering of the Fed rate, has become more material, and tax attributes have been either suspended or capped, the apportionment evaluating the apportionment becomes so much more significant, and there's a lot of opportunity with regards to how to apportion, especially when it comes to sales of other than tangible personal property, because there's the rules of cost of performance and market-based sourcing are really murky and pretty subjective, and there is no requirement that 100% of sales, for example, be apportioned. So there is, it's only states can have their own apportionment rules and their own methodologies. The only requirement is that a state, if that state's rule were to be applied by every state, that there wouldn't be hypothetically more than 100% apportioned. but there's no requirement that that it be kind of externally result in 100% apportionment. So that's where in analyzing the sales factor apportionment, it's important to really make sure that we're maximizing any potential nowhere sales. And we're also seeing kind of the flip side of that, where states are aggressively evaluating the sales factor as well, where we see there's been a Pennsylvania case a couple months ago, a ruling in a tax department ruling in Florida, and in Texas, this Sirius XM radio case, where these traditionally cost performance states, which would statutorily require sourcing based on where costs are incurred, seeing them interpreting those cost rules to be more of a market-based. So like Sirius is an example where Sirius Radio had subscribers in Texas, but all the costs related to the infrastructure of Sirius were outside of Texas. So one would typically think that the right answer would be to source those sales outside of Texas because the costs weren't incurred in Texas. However, Texas, in their ruling, determined that that the item of income and the situs for the cost was actually where the benefit was received. Seeing similar kind of reads of certain sourcing, kind of states trying to assert kind of a market-based approach and apply to cost of performance statutes. We've seen it just in 3 states pretty recently with Florida and Pennsylvania and Texas. So we're seeing the flip side of it too, where states are aggressively pursuing the subjective nature of sourcing. But I think more importantly, it's important to take the offensive there, and also use it to your advantage. So I think from a state perspective, it is really, there's a whole lot of opportunity with regards to reducing tax through a reduction in sales factor apportionment. And Debbie, did you want to go to the polling slide?
I do, yeah. Let me circle back on that really quickly. So let's jump to polling question number 3. I'm going to launch this. I know some folks are saying it's taking a second to load on the screen. If you don't see it, or if for some reason you can't answer before I close the poll, just put in the chat box polling question 3 in your answer, and we will make sure that it's recorded for CPE purposes. So we'll give you a little bit of extra time here. Get those answers in. We're at about 72%. Getting up to 80. All right. I'm going to close the poll here in 3, 2, and 1. All right. Looking like folks are paying attention to what you guys are saying. All right.
Who doesn't want to reduce their taxes?
That's
Any
right.
taxes.
That's
Absolutely.
right. All right. So are you good on this slide, Alex? Do you want to go to the next one?
Yeah, I was actually to conclude on slide 12, where we had
Yes.
apportionment, and that sort of dovetails with that last bullet point there on apportionment and how do shelter-in-place orders impact or benefits are being received by customers, but also in calculating cost performance, it could really change. These shelter-in-place can also have impacts on apportionment too, in terms of payroll factor. It can impact our cost of performance calculations on where the costs are incurred in providing services. It can also impact where our customers, whether they have employees working from all over the place, and can impact on where the benefit is being received from our products. So those are things that are being asked, and lots of questions that are being raised due to kind of this new way in which we're working. And Debbie, you want to flip to, I think we can go to slide 15. Yeah.
Okay. I'll jump in here just to finish up with some other miscellaneous things that we're seeing on a day-to-day basis. There are challenges. There are lots of challenges for taxpayers these days, but here are just a few bullets of some things. Number one, Oregon has a new corporate activity tax. This is in addition to their regular corporate income tax. This new corporate activity tax, they call it the CAT, became effective on January 1, 2020. It's kind of a funky hybrid of an income tax and a gross receipts tax, and it's not a sales tax. It applies if you have Oregon-sourced revenue of $750,000 or more. The rate of tax is 0.57% on the taxable amount. The taxable amount is determined by taking your Oregon gross receipts and then subtracting a deduction of 35% for certain business expenses. So just be aware that this is out there. We can talk more. Let us know if you've got questions, but if you're selling into Oregon and have more than $750,000 in Oregon sales, pay attention. The next one, and this seems to be a trend, states, jurisdictions are coming up with new taxes to supplement what they've already got. Seattle passed a new payroll expense tax, and that would apply if you have more than $7 million of sales into Seattle, if you have employees making more than $150,000. This is a tax imposed upon the seller or upon the employer, excuse me. And so it's important to be aware of this. We can talk more again if you've got more questions, but just be aware of it. Finally, another challenge is expect more states to subject digital goods and services to sales tax in 2021. We know that states are hungry for money right now due to COVID. They don't have the sales tax money coming in, profits are down, they need money. So the easy way to get money is to take their existing infrastructure for sales tax and just add more goods and services to the list of things that are subject to the tax. And the easy thing to do would be adding digital goods and services. Already 20-some states already tax this type of digital product, but that leaves another 20-some that don't. So expect those states to be added on. If you're a SaaS provider, watch out. 2021, it's likely you're going to have to start doing your nexus study and taxability study to determine if you need to start charging sales tax in more states. Also, talking with the Washington Department of Revenue executives yesterday, they said, yeah, our auditors are working from home, we're having furloughs, we are being very quiet right now on purpose, but they are going to come out with a vengeance once COVID lifts with new audits. So if you don't have your tax house in order, watch out because they're coming.
Yeah, and that's what I'm hearing too, especially from like the non-sales tax side, and that, and it's really going to, I think the first area of focus is certainly going to be the non-filing, non-resident tax holders. So based on a lot of these Wayfair economic nexus principles with market-based sourcing, I think that's going to be the first area of attack for these is to be going after kind of the non-resident, non-filers.
Very good. Let's talk about some opportunities. That's enough bad news for now. Where there's lemons, you make lemonade. So remember with Wayfair, we now have states imposing a sales tax collection responsibility on many vendors. So if you as a business are buying goods and services, which we all do, in the past, your AP department has been very vigilant about watching the invoices and determining if the vendor did not charge sales tax on something where sales tax should have been charged, presumably because the vendor did not have nexus, then the customer, your business in this case, is required to accrue and remit the equivalent amount of the sales tax as a use tax. Well, here's a benefit of Wayfair, if you will, that the vendors are now charging sales tax. So you need to have a conversation with your AP department and say, hey, let's just make sure that we're just not on autopilot in accruing use tax on the purchases that we're making. We need to be watching these because vendors are now charging sales tax. So our use tax obligation should be going down, and less work internally to accrue and remit that use tax. So there's one good thing. Alex, you want to talk about payroll taxes?
Certainly. And this is really about the local payroll-based tax, like San Francisco payroll tax. And but it really, the opportunity itself is, as we discussed a little bit earlier, there is such significant opportunity with regards to apportionment, throwback, application of throwback, and reduction of really the primary factor that's driving state tax these days, which is the sales factor. There's just tons and tons of opportunity with regards to reducing that factor through a thorough analysis. I mean, we're finding a lot of various opportunities to do that. And from the local tax side too, is these payroll opportunities are, take San Francisco, for example, which has a payroll tax, but also has a corresponding gross receipts-based tax, half of which the apportionment ties into payroll for some. The other half of the categorizations would apply a 100% payroll-based apportionment kind of methodology. So the apportionment of the payroll for taxes like San Francisco, and there is a lot of synergy with LA too and other California locality taxes, because payroll is oftentimes used as the apportionment methodology for the gross receipts tax. There's a lot of just significant amount of benefit to really evaluating that payroll. Seeing a ton of refund opportunities with regards to San Francisco, especially, and not just because of the shelter-in-place rules, but that's created even more opportunity. But what we find is a lot of taxpayers taking kind of their ADP sitest payroll and just using that number as their locality-based payroll. So those that have a San Francisco, for example, sitest ADP payroll, using that as San Francisco payroll. However, these taxes would only they only require that that the payroll actually earned in those jurisdictions is what gets reported. So we're finding just somewhere generally between 30 and 60% reductions in the local taxes by just really kind of digging in, and whether it's pulling key card data or doing some evaluation of when people were actually working in the office versus out of the office, sort of doing it in out on that San Francisco based payroll is generating significant refunds. We're also finding that that the work from home is creating significant benefits for the the upcoming tax year. So that's also important. If we haven't already done an apportionment of the payroll, it's critical to do that this year, because a lot of employees that are sitest to work locations in like a San Francisco or LA are actually working for most of the year outside of San Francisco or LA. So significant opportunities generally with regards to apportionment and throwback, and specifically with regards to a lot of these California local taxes that can be material like San Francisco or Los Angeles.
Awesome. Cool. Love opportunities. Let's see, very quickly, just before we end the SALT session, we did have a question come in through the chat. Thank you. The question is, does someone have Nexus if they work out of the country but have a business registered in the United States? Well, a business registered in the United States, again, Nexus might be economic Nexus. So again, we need to look at sales thresholds, transactions counts, employee locations. Business registration by itself may or may not trigger a sales tax collection responsibility. We were actually having that conversation amongst the partners a couple of weeks ago, and I did a little research. Some states say no, some states say yes. So as a typical consultant answer, the answer is maybe. It just depends on the facts. Okay, Anything else to wrap this up, Alex? You want to move on?
No, I think that yeah, I mean, I think just along those lines is it's important to even foreign. So yeah, that the last, I guess, point on that is that we are seeing a lot of foreign entities where it is important. So a foreign entity can trigger nexus based on sales. So from an income tax standpoint or non-sales tax, in addition to the sales tax collection and remission, there can be a foreign obligation to collect and remit. I guess the question is there as well, then what could, if there's non-compliance, what can the states do? Well, I think and the answer is, oh, the states can't, not much if you're non-filing, unless there's an affiliated entity or some sort of U.S. presence through an affiliation, in which case they could enforce a tax judgment on an affiliate. So those are kind of but it is important for technically these economic nexus provisions can apply to a foreign entity making sales into the U.S., even if that's all that they do.
I'm going to jump to the last polling question here, and then we will transfer into transfer pricing. So, quick poll. Why are we expecting an increase in SALT audits? Many options there. Again, I'll leave this open for folks who might need a second for the question to load. Make sure you get those answers in. And again, we'll be sending out the slides and the recording following the presentation. If you've got any questions, do submit them. If we don't have time to answer them during the webinar, we will have our folks follow up with you after the presentation. We'll close the polls here in 3, 2, and 1. Perfect. Looking good.
Yeah, and Debbie, before we transition to transfer pricing, I'd be remiss to not give our COVID-19 state matrix a plug, in that we as a group have been monitoring all of the hundreds and hundreds and hundreds of state tax extended due dates and relief measures from the localities to the counties to the states. So that's updated nearly daily, at least every couple of days, and uploaded to our website. So we do have a pretty comprehensive COVID-19 state matrix that does provide a lot of helpful information. And if anybody has any questions with regards to what's in there, please feel free to reach out. But that is pretty helpful information, especially when it comes to pulling together all the different extended deadlines where there might be relief measures or nexus exclusions and that type of information.
Yeah, that's a good call, Alex. And I'll add that to the presentation when I send it out so that everybody has that link readily available to them. Perfect. All right. And we'll go into transfer pricing with Nee. And I know that Alex is going to kind of jump back in here again, but we'll kick it off.
Hi, everyone. This is Nee Wynn here. I'm transfer pricing partner at Armanino and leading the practice. Thank you, Alex and Darcy, for your wealth of information. As you guys can see, there's plenty going on at state level, and our team's been helping our clients, with opportunities, but also address issues. So with today's presentation, I wanted to just cover, areas of current interest in transfer pricing in light of, one of our court cases, as well as how companies are dealing with transfer pricing under the current environment, areas that we should, consider in terms of overall transfer pricing documentation, just the rampant increase of documentation requirements that the foreign tax authorities have been releasing on a very consistent basis. But what I'd like to cover, first of all, is the Altera case. And Alex and I are going to discuss this together just because there's, I'll cover the overall, provide an overview of the Altera case, but also Alex will discuss some of the state considerations that taxpayers should consider, just because it's not as straightforward as one might think. So earlier this year, on June 22nd, the Supreme Court decided not to, deny the petition for certiorari for the Altera case. And the Altera case really applies to taxpayers that have a cost-sharing arrangement in place, and cost-sharing arrangement in place to share, what typically it's development costs related to R&D, intangibles, or marketing. And this has been a long litigated case that's gone back and forth, with the tax court and the Ninth Circuit, where taxpayers argue that they should not have to include stock-based compensation in the cost pool when they are sharing development costs between, the U.S. parent company and a foreign related party. And they argue that unrelated parties at arm's length would not share stock-based compensation costs. And this has pretty significant implications, especially for tech companies that issue stock-based compensation. And so this has been a material impact to companies like Facebook, Apple, and as a result of this, taxpayers have had to revisit their position where they have not included stock-based compensation cost pool. And what it means is that if they did not share stock-based compensation with their foreign affiliate under these arrangements, that would imply that the U.S. taxable income, as a result of the Supreme Court and decide not to hear it, it means that the Ninth Circuit decision, where the Ninth Circuit ruled in favor of the IRS that stock-based compensation should be included. So as a result of that, if you do have a cost-sharing arrangement in place, then you do have to share the stock-based compensation. And what that means is that there would be more taxable income potentially to the U.S. taxpayers as a result of upholding the Ninth Circuit's decision. And so there's, significant implications, obviously, for companies that are in this particular fact pattern, and, as well as if it's, if the stock-based compensation portion is a very significant amount. So it also has implications for, potentially could also have implications for situations where you are providing intercompany services and you decide not to include stock-based compensation in that arrangement just because the IRS may, take the view that stock-based compensation in general, whether it's for cost-sharing arrangements or it's for provision of services, stock-based compensation should be included. So what are the implications? So generally, if you are in the Ninth Circuit, from a federal standpoint, most of the taxpayers will follow the Ninth Circuit's decision where stock-based compensation should be included. And a lot of taxpayers have already included this reverse clawback provision in their cost-sharing arrangement where, if there is a certain triggering event, decision by the court or, a hearing by the Supreme Court, but, we don't have that case, we don't have that situation. But if there's a trigger event where in this case, the Ninth Circuit ruled in favor of the IRS, the taxpayers would revisit their cost-sharing arrangement and due to this reverse clawback provision, then have to include the stock-based compensation and share that in the cost-sharing arrangement. But what that also means is that you have to in light of the TCJ, in light of all these, as a result of TCJ and as a result of the COVID provisions, if you are then going to include the stock-based compensation in the cost pool, taxpayers, it creates kind of a myriad of challenges for taxpayers, and one of them has to do with timing. like generally when you make an adjustment for the cost sharing arrangements to include stock-based compensation, you generally apply and go back to the years that you should have included stock-based compensation. But with a reverse clawback, there's a question as well, should you take that pool of adjustment, aggregate pool of adjustment, and take it in all in 1 year? I mean, due to TCJ, there are some, pros and cons of, whether you go back to the prior years and make the adjustments individually each year, or do you take it all, like, for example, in 2020, meaning you make that adjustment all in 2020 reflecting on your tax return? I mean, it's pros and cons just because if including the stock-based compensation increases taxable income, one benefit is like under the current TCJ, the tax rate's 21%, whereas previously the tax rate was 35%. But it's not really straightforward just because of, in the previous year, if you go back, it also could, if you have to include stock-based compensation, you're also reducing your foreign entities EP. It has implications on your GILTI calculations as well, and potentially, any 965 transition tax that you might have paid. And then also you have to take into consideration the NOL carryback provision under COVID-19. So it's not a very straightforward answer in terms of what taxpayers should do, and we're certainly looking for additional guidance from the IRS, but nothing has been released to date in terms of Altera. I mean, I'm sure the IRS is busy, obviously, with all the release of other, international provisions. So not sure if we will hear anything in terms of further guidance on how taxpayers should, what they should do with the stock-based compensation adjustment for 2020. So this is definitely something, item that, we're recommending clients to visit in terms of provision purposes on the quarterly and for your year end, and what that would, and the impact it may have on your tax provision. And also consider, even though taxpayers may have documented their cost sharing arrangements in the past, I mean, to the extent you did not include stock-based compensation, that's going against the regs. So even if you have documentation in the past and your stock-based compensation adjustment amount is potentially pretty sizable, it could lead to, penalties of 20% or 40% depending on the penalty amount. So certainly a lot to deal with, but it's not, and I know a lot of our clients have already prepared for the possibility that the Supreme Court was going to deny the petition for rehearing to Altera, just because it wasn't expected to be heard by the Supreme Court, so not, but just to reemphasize again that this is something to be looked at on a quarterly and year end. But now I will also turn it over to Alex because, from a state side, it's not as straightforward in terms of what the implications are and how taxpayers should treat this new, in light of this new event. So
Nia, I think there is a silver lining, I think, or there at least can be a silver lining to the Altera decision. But as Nia indicated, the real significance of the U.S. Supreme Court denying cert and why it's relevant now as opposed to when the Ninth Circuit decided the issue from a state perspective, at least, is the geographical divide it created, and it's rare that we see this type of geographical divide. But what wound up happening is we have the U.S. Tax Court in a unanimous decision, 15-0, concluding that these stock-based comp did not need to be included in these cost share agreements, so that, however, the Ninth Circuit, which is the most overturned circuit of all the circuits, decided 2-1 with a vigorous dissent to overturn that U.S. tax court decision. But then when the U.S. Supreme Court denies cert, it creates this geographical divide because all non-circuit taxpayers aren't subjected to the Ninth Circuit decision. Only those in the Ninth Circuit would be bound by that ruling. So we have two conflicting rulings. One which, if you're in the Ninth Circuit, the reason that that's binding is because if the IRS were to audit a taxpayer in the Ninth Circuit, then it would get appealed. It would get appealed right back to the Ninth Circuit, which would be bound by the Altera decision. Not so outside of the Ninth Circuit, where if the IRS were to audit it and went to tax court, it would then get appealed to a different circuit, which would not be bound by the Ninth Circuit decision, which is why we're seeing, for the most part, a lot of taxpayers outside of the Ninth Circuit not making these Altera adjustments, but those in the Ninth Circuit are, which creates a situation where you have similarly situated taxpayers in the Ninth Circuit with higher taxable income, federal taxable income, than taxpayers outside of the Ninth Circuit. Now, for state purposes, it creates, I think, an often overlooked area of, I mean, I guess there could be some detriment because we can't necessarily forecast how exactly all the courts would come out, but it seems to me there's a pretty good argument for all those Ninth Circuit taxpayers making the adjustment from Fed purposes to really think through, is that an adjustment we need to make for state purposes? Because in my opinion, there's potentially significant either refund opportunities or mitigation of this adjustment from the state purposes, because what we're going to see a lot of is taxpayers taking the adjusted higher federal taxable income and just putting that higher taxable income number on their state returns. However, the states, for the most part, aren't obligated to file as filed, but in accordance with the IRC. So, so depending on the logic behind it and the technical basis for it is that to the extent a state authority were to audit that income tax return, it would get appealed through the state courts, and the Ninth Circuit decision is not binding on those state courts. So there is an opportunity to reverse the Altera adjustment for state-only purposes if in the Ninth Circuit, and the logic and rationale also is supported by there's Supreme Court case precedents that states can't treat similarly situated taxpayers differently based on where they're headquartered. And in this case, if you had a New York headquartered company, the exact same profile as a California-based company, for example, one would have a higher federal taxable income than the other merely because of where they're headquartered. And that's prohibited. So either the New York company would either have to make the adjustment because we would conclude that California would agree with the Ninth Circuit or not. But I think the thought is that given the persuasiveness of the U.S. Supreme or the U.S. tax court's 15-0 decision, that a significant number of the states would probably side with the U.S. tax court and not require the SBC, that the stock-based compensation be shared. So really, I think there's a significant opportunity to not just overlook the state side of the Altera adjustments and see if maybe there's an opportunity to exclude that amount, so there's a lower federal taxable income number used for state purposes only. And that being said, even to the extent that there is a position where taxpayers want to share those costs, it's also important to evaluate what is being done from an apportionment perspective. So are those CSA payments being included in the sales factor? There's are we grossing up the buy-in royalty for the sales factor? Apportionment of the reverse clawback using potentially historic factors if those are favorable. So I think there's a lot of either mitigation or planning opportunities with regards to the state impact of Altera to the extent it's material.
Thanks, Alex. Hey, really quickly, we're getting a couple of questions in here on that first bullet, saying that the cost sharing arrangements are not binding. Is that correct, based on what you're saying?
Well, they're not. So the Ninth Circuit decision is not precedential for state purposes, is what that means.
Perfect. Thank you. I
So
think some people wanted some clarification on that.
yeah, so meaning that the California courts are not bound by the Ninth Circuit decision.
Perfect. Thank you. All right, really quickly, let me jump to another polling question. The Altera decision was released during which month?
I might have not indicated it, but I'll give you guys a freebie. That was in June.
Oh, you did. It was very at the very beginning.
Oh, I did. Okay, I gave away the answer.
Well, that's okay. We like to make it a little bit, you know, easy on folks. So perfect. Give you a couple minutes to get that in. Inching up there. And again, if for some reason you don't see that polling question, just make sure you put the polling question 5 and answer June in the chat box, and we'll get you credit for that. All right, we'll close the polls here in 3, 2, and 1.
Okay. All right, so the next topic I wanted to talk about is just overall transfer pricing documentation game plan for companies. I know taxpayers, there's a lot to deal with, and transfer pricing documentation may not be at top of mind, but the documentation requirements, not only from US and foreign countries, is just growing significantly. And there's constant updates now with everybody. I mean, all the major countries have adopted the whole concept of the master file, local file documentation approach that was released by the OECD as part of the OECD BEPS action item. And then that master file, local file documentation approach essentially just breaks down transfer pricing documentation, into 2 files. The master file provides an overview of your company's global operations, and we talk about intangibles, we talk about functions and risk of entities, what your transfer pricing policy is. And companies can think of the local file as your local transfer pricing documentation that shows how your tested parties results fall, fall within the range or for that year, and that's what's typically your transfer pricing documentation that a lot of companies have put in place. But what's complicating the situations now that with a lot of companies operating internationally, our recommendation is to always have a game plan in place in terms of creating this matrix of where you're outlining what are your key jurisdictions, what are the transactions there, and then aligning that with each country's master file, local file requirements, and what kind of documentation support you have and what the triggering thresholds are. And if you're operating in more than 10 countries, this could be pretty sizable exercise itself just to determine what's the best spend for your money, right? Because you certainly don't want to have 10 to 15 different local files if you don't need to, but maneuvering through all their local requirements and what those thresholds, what they are is certainly challenging, but I think it's a worthwhile exercise for companies to take on in terms of how do you approach what is your transfer pricing documentation for 2020, especially with the 2020 year end coming up, you certainly need to budget for it because what I started to find is a lot of our clients are getting caught off guard in terms of certain countries have lower thresholds for documentation than expected. And so it's better to look at the requirements sooner rather than later before year end, rather than get caught off surprise and not realize you have to prepare documentation in certain countries that you did not, anticipate. And just real quickly, I did list out certain countries, where it's either a new notice came out or where you may not have expected to have documentation in place. Ireland being one of them, they have, master file, local file documentation effective January 1. Ireland historically has not had transfer pricing documentation requirements, so some taxpayers may, get surprised with this new requirement. And if you notice that the master file, local file documentation requirement, it gets triggered if you have global revenues of 250 million euro for a master file and 50 million euro for a local file. I mean, similarly with Netherlands, I think a lot of taxpayers are now used to the fact that Netherlands local file gets triggered if your overall group revenue is over 50 million euro, which is, it may catch some folks off guard just because it's a lower threshold and it's a global. It's not just the Netherlands local entity, but just for the overall company. And Germany is another one where, while the master file threshold trigger is a lot more significant, that's if you have sales exceeding 100 million euros. But the local file, depending on the type of transaction, that could easily get triggered, especially if you have services transaction that exceeds 600,000 euro, which is, a lot of times taxpayers do exceed that amount and are not aware that they do have to file local file in Germany. We were working on Puerto Rico's an interesting one. We are working with a taxpayer in Puerto Rico just to prepare a documentation study to support the intercompany charges, just because under the new law, without a transfer pricing in place, the government's going to disallow the intercompany charges. So it's an absolute requirement in that respect. And not surprising, just because in South America, there's a lot of documentation requirements that have already been released, especially in Mexico. It's one where pretty low threshold as well. But that's been around for some time. Chile just released new transfer pricing documentation rules, but that really applies more to larger companies. And then I just wanted to circle back on top and talk about the IRS. IRS hasn't released transfer pricing documentation and guidance in quite some time. So when they did release transfer pricing documentation frequently asked questions earlier this year, I wanted to highlight it to a lot of our clients just because they're taking note on type of the documentation, the quality of it. Because they did release in 2018 a directive saying that just because you have transfer pricing documentation in place, just the mere existence of it does not relieve you from penalty protection if the quality of the documentation study is not up to par. There's certainly a list of, 10 general principle indexes in terms of contents you have to cover. But now the IRS is focusing on the level of effort taxpayers are putting into covering those content. An area of focus is just robustness about the functions, risk, and asset section. So to extent historically, that section has been really light in identifying what the functional activities are of the parent company versus the local or foreign entities. That needs to get augmented, and taxpayers should revisit their transfer pricing documentation, especially if it's been over 2-3 years. A lot of times for the U.S., taxpayers have relied on historical transfer pricing studies that have been perhaps done once, but have not been updated to reflect the new functions, assets, and risk of the U.S. entity versus what's been happening with the foreign entities. And especially there is now an area of focus on, aligning what's stated in the intercompany agreements with what's actually happening on the ground, like are the intercompany agreements in alignment with the actual activities of the entities. And then last, I want to point out from transfer pricing documentation, what the IRS is looking for is, making sure you have like a transaction summary table in place. It's just helping the IRS identify what the transactions are, the dollar amount, and what methodology that's being applied, and how the tested parties have fared, their results in comparison with their benchmarking ranges. And that's just to help the IRS really pinpoint what are the areas of risk rather than going through all the intercompany transactions. So to extent, companies haven't really looked into the U.S. documentation studies for quite some time. That's, something that people should consider for the 2020 year, especially, with the budgeting season coming up. But also, you need to consider what foreign transfer pricing documentation the company would be required to also prepare to cover 2020. Okay, so the next section I wanted to talk about is, revisiting transfer pricing due to COVID. I think for some companies, this is top of mind, especially if the industry, if your specific industry has been directly impacted by COVID. We've talked to a lot of our clients over, starting in March and through the summertime, just to understand what the impact has been. For certain taxpayers, they have been significantly impacted, but some, for some of our tech clients, the impact has not been as severe. Some impact to the top line, but a lot of what we're hearing from clients is they've been able to manage with lower expenses. But certainly, it is an opportunity for companies in general to revisit the transfer pricing, and to the extent there is support for revisiting the transfer pricing, it's an opportunity to also potentially look at saving cash in terms of how much taxes you're paying in the foreign jurisdictions, like especially to the extent you have limited risk distributors in place, or service providers under a cost plus model. And in terms of types of analysis that we've talked to companies about is taking into account what the impact of COVID on the business. It could mean that you've incurred more expenses, inventory write-offs, or asset impairments, or just underutilized, employee force, where you've had to really pay employees regardless of whether they were performing the functions or not, just to keep them employed. So these are, to the extent the company is incurring COVID-related costs, and to the extent they are material, there is an opportunity to take a different treatment in terms of those expenses in preparing transfer pricing documentation. Another alternative, solution is to just look at the benchmarking results and looking at not just benchmarking results of the last 3 years, which is what we typically do when we're preparing transfer pricing documentation, but just looking at the transfer pricing, the benchmarking results back in 2007, 2008, under the economic depression years, and just understanding what the impact to those benchmarking results during that time would look like, and using that as the years of analysis for 2020 when you're doing documentation next year. Because otherwise COVID will not, you're not going to see the impact of COVID for maybe a couple years in terms of how it's impacted the third-party comparables too. And lastly, sometimes you can also look at making adjustments to the test party results and looking at measures in terms of like impact to revenues, impact to expenses, and making those adjustments to the bench third-party results as well, like doing some sort of regression analysis where you're looking at the impact to the sales or impact to expenses as a result of COVID, and how you would then adjust their benchmarking results pro rata based on that type of analysis. Okay. The next slide, I just wanted to go through that to the extent companies are considering making adjustments. It involves more rigorous analysis, obviously. And the reason why I say that is because some taxing authorities have released guidance on what they expect to see in terms of documentation to the extent you are going to make an adjustment. And of course, you know, taxing authorities are a little wary of taxpayers making adjustments due to COVID, only because this has been an issue that's happened back in 2007, 2008, where, you know, of course, similarly, taxpayers were making some, you know, adjustments to their financials or their transfer pricing as a result of the economic hardships at that time. So obviously, just in surveying, actually, in some of our colleagues overseas in Europe, it seems like some taxing authorities are taking the position that, well, while COVID did have a, you know, significant impact to the economy, to taxpayer results, they're a little bit more hesitant or in terms of, you know, accepting adjustments. And to the extent you have limited risk distributors or you have routine service providers, just to caution, you know, the folks on the call that our initial feedback is that they may not accept any adjustments to limited risk distributors or your routine cost plus service providers, even though COVID impacted the operations, meaning they may not accept like losses for limited risk distributors or a lower margin. But I think there's still opportunities for taxpayers to make some level of adjustment, but it may not be like a blatant adjustment where you're making wholesale changes to transfer pricing policies in that extent, just because there certainly are, you know, longer term, you know, implications when you're making wholesale changes to transfer pricing just for COVID in that 1 year. So certain, you know, consideration should be taken on whether, you know, should the policy be changed at all, even in light of COVID, or, you know, are minor adjustments to, you know, more practical approach where you're not saying you're making wholesale changes to transfer pricing policy, but taking into consideration COVID in some level, but, you know, either to making adjustments to your own tested parties' financials, like carving out certain expenses so that the adjusted still be within the range. But here's a list of just consideration that you should take, and, you know, comparison of what is, you know, how did COVID really impact the company? Like, can you demonstrate the impact of the financial statements, like in the percentage of change to either top line or bottom line, and how the industry overall has been impacted? I mean, to the extent it's an entire industry has been negatively impacted, I think that, you know, provides more support in terms of how taxing authorities may look at any adjustments. Okay, lastly, just on transfer pricing triggers, just to, you know, the slide is just to reiterate where taxing authorities are going to focus their efforts on. Again, it has, you know, the theme lately has to do with aligning functions around profits with the functions and risk of entities, making sure that your agreement has been updated to reflect, you know, appropriate pricing with what is occurring locally on the ground in terms of your activities. Okay, So Debbie, do we want to go to the next polling question?
Yeah, does that work for you? Cool. All right, so quick polling question. And this one you may not have mentioned, Nee, but when did the IRS publish the FAQs focused on transfer pricing documentation? Earlier this year. I can help you cheat on this one. It was in April.
Yeah, sorry, I actually did not mention that one, so they
All
did.
good, all good. There you go. We're course correcting. We're all jumping on the right answer now. It's okay. The CPE doesn't matter whether it's correct or not. So we'll get those in. Looking for a handful of additional folks to submit those answers. We'll close the polls in 3, 2, and 1. Perfect. All right, and it looks like we're up to John. John, welcome, sir, and it's all on you.
Can you hear me okay?
Yes, we can.
Excellent. Now we've gotten to the most exciting part of the webinar, that circulates around international tax. And if you want to move to the next slide. I want to talk about a couple of things just with regards to some issues that we're seeing come up more and more frequently. Alex touched on this from a state and local perspective, but it also is encountered quite frequently in the international arena, specifically around the permanent establishment taxable presence creation when we have employees going from one jurisdiction to another. Also, in the case of COVID, with people working in one country and either being trapped there because of COVID quarantine or moving back to be your family, whatever the case might be, it happens quite often. Many countries have done COVID carve-outs and whatnot, but this issue continues to be an item of concern and analysis for many companies that have mobile employees. And just very basically, a permanent establishment or taxable presence creates essentially a taxable situation in a foreign country if those activities that are occurring in that foreign country on behalf of the, for example, the US or one of the other countries rises to the level of creating a permanent establishment. Now that's defined under tax treaties. Where there's no tax treaties in place, that's defined by the foreign jurisdiction's statutory or local law. Typically, a permanent establishment includes a fixed place of business. Either it's an office, it can also be a person's house, it can be a factory or a vendor or a customer location. So it is quite broad in terms of the specific definition. In addition, there's the concept of agency PE, where you have either a third party or an employee in a jurisdiction that is able to conclude contracts or otherwise bind the company, and that is occurring in that jurisdiction. So when that happens, a permanent establishment can be created. Now, the ramifications of having a permanent establishment or taxable presence, and probably the most typical one is through the use of that we see in companies is the use of independent contractors for R&D or something like that are being paid independently, and really they're working full-time for the company. We had a situation recently where we had 60 people working in Russia for a client that were all being paid effectively independently, and they worked for the company full-time. Definitely a situation where, because of the development type activities, you want to make sure and address that in a manner where it's very clear that the work product that's being performed and provided to the U.S. company is not going to be treated as being developed in Russia. We want to avoid a permanent establishment in that case. And so it really makes sense to evaluate, whether or not to do something about that permanent establishment or taxable presence. There's a lot of other situations that are very common, especially independent sales representatives that turn out to be not quite so independent. Turns out they don't have any other customer clients. They're only working for the U.S. company. That's another situation where they hold themselves out as, representatives of the U.S. company. Those are all situations that can create this permanent establishment taxable presence perspective. Now, one of the reasons we're talking about today is, and this has been an issue for a number of years, but during a financial statement audit, it is definitely an area where the financial statement auditors are concerned about this. It's on many of their checklists and questions. And so it's not a difficult analysis, but it's one that should typically be performed on where all the employees of the company are located, to the extent that they're not employed in a local entity, or independent contractors. Those should also be evaluated for application of potential permanent establishment exposure. So what do you do if you have, the situation where you have 4 or 5 people, or 10 or 15 or 50 people in a country? Maybe we can go to the next slide. Well, we typically look at that point in going to forming some sort of registered presence in that country. And there's a number of different ways to address that. Typically, if we have this potential for permanent establishment, the first tier is to use an agency or a PEO organization, or PEO, professional employment organization, that effectively employs those personnel in that jurisdiction and ensures that all their payroll taxes and other filings are being taken care of. That's probably the largest risk when we encounter, independent contractor or remote employees where the U.S. company is not registered for payroll purposes in that country. Income tax kind of takes a second seat in terms of exposure. It's really that payroll tax considerations, which can be upwards of 60% of the person's salary. So first step, we look to, can we use a PEO? Can we use some other form of agency to ensure that they're in compliance and insulate the U.S. company a little bit from that potential income tax exposure? Second step is to evaluate the types of activities that are being performed by the people in that jurisdiction, and determine whether or not we're able to use a rep office or a registered office, representative office. Typically, those in many jurisdictions, those have limited scope, and so typically it's around the sales and marketing activity. Some have broader scopes, some have more limited scopes. So it's really evaluating whether, and the registered office or representative office is typically a non-taxable entity. So typically under the tax treaty that's in place between those jurisdictions, it would not rise to the level of permanent establishment. The next step up from that is a branch or subsidiary. And I kind of combine those two in talking nowadays. 15, 20 years ago, there was branches were sometimes taxed at a more favorable rate than legal corporate entities or LLC entities. Now, that with very few exceptions, those are taxed virtually identically. And so we with the exception of countries like, for example, Taiwan and some others where it's beneficial to be in a branch structure. But effectively, what we're doing here is putting a box around the activities that are being performed in that country. Those employees, the local entity is established, again, whether it's a branch of the U.S. company that registers for tax purposes, becomes a taxable presence there, and is able to take care of the payroll and other filings and whatnot. Typically, we'll fall to recommending a formal legal entity, an LLC or corporation, so that there's a stronger box as opposed to a branch around that entity or around those activities. Again, register for payroll tax, and typically will receive some sort of cost plus remuneration, or it could be a situation where that's the opportunity we take to switch it over, the local entity over, to a limited risk distributor arrangement or something similar, as Nii kind of alluded to previously. Next slide. So once we've kind of put our box around that foreign establishment, that taxable presence, we now fall into how the U.S. treats the income being generated from that entity. And that takes us into global intangible low tax income, the GILTI tax, if you will. which is, I'm sure many of you are aware of, been in place since December of 2017 and really applies to 2018 returns forward, where effectively the any income that's earned by a foreign affiliate, or basically a controlled foreign corporation of a U.S. Shareholder, will be included pro rata based on shareholder percentage into the U.S. company's income. Now, that seems pretty onerous, but there are some things that the Congress has put in place to kind of temper that. First, the U.S. shareholders allowed a 50% deduction against that income. So while the tax rate in the U.S. corporate rate is 21%, as we learned earlier from our polling question, the GILTI effective rate is 10.5% for companies that are in a tax-paying position. Now, against that 10.5% effective tax rate, the U.S. company is able to use 80% of the foreign taxes that are paid in that foreign jurisdiction as a credit to offset that 10.5% rate. In addition, and something that was, for which the regulations were just finalized here recently, is that it is possible to use a high tax exception for GILTI. And this is very important for companies that are in a loss, because GILTI income is a 21% hit if you have a loss, because you're not able to get either the GILTI deduction or utilize the foreign tax credits. And those foreign tax credits do not carry forward. It's a year-by-year evaluation, so they're basically lost. So if you have a loss in the U.S. company, but you have taxable income in the foreign jurisdiction, you're bringing up that taxable income, you're paying tax in the foreign jurisdiction, you bring it up to the U.S., it offsets your NOLs, and is basically taking down your NOLs at a 21% rate. Now, in order to, again, that's where the high tax exception comes into play. So if the rate of tax that you're paying in that foreign jurisdiction, when evaluated under the GILTI net tested income process, is greater than 18.9%, you can exclude that income from being included in your U.S. tax return and offsetting your NOLs. It also applies if, based on the mix of GILTI tested income versus loss, and you are paying tax in the U.S., that it would be beneficial to exclude that income. So it's very important to model that out. We've been doing many modeling exercises just in the last several weeks since those high tax exception final regulations came out, which were the final regulations have turned out to be much more favorable than the proposed regulations. If we go to the next slide. On the other side is FDII, or foreign derived intangible income. So GILTI is a hammer to beat you down as a U.S. taxpayer, and including your foreign income, but FDII is a benefit, and that allows you to receive an additional deduction for sales made to foreign persons. So basically, as long as the customer and the beneficial use of the service or product that you're selling is outside the U.S., you can get an additional deduction of 37.5% relating to that net income, which results in an effective rate applicable to that income of about 13.8% instead of 21%. So what does this mean? Sales to foreign customers from U.S. company, great. Let's maximize that income. And, over the last several years, we've done dozens and dozens of what we call these FDII maximization projects, where because effectively what you want to do is allocate as little as expense as possible to this income that's being generated by foreign customers, so that you're able to maximize that deduction and thereby reduce your effective tax rate. It does apply to a number of a broad base of services, as you can see here. Sales of property, sales of intangible property, and service. Basically anything you can think of. There are some nuances around financing income and things like that need to be carefully analyzed. But typically, if you're selling a service or a product to a foreign resident, you can qualify for this income. So very beneficial, again, but very important to analyze and review the expense allocation so that you're able to maximize the deduction around the foreign derived intangible income. Next slide. So value added tax, and this is probably one of the most overlooked areas besides Darcy and Alex and sales tax and whatnot that we see as we go through due diligence processes and engaging with clients that are on a growth path where they're spending more time thinking about growing the business than they are about tax, because this value added tax has really been transformed in the last several years around digital e-services. And I'll talk specifically about that, and then we'll talk a little bit about as well about value-added tax for product transformation or product transactions. And when I talk about VAT, I'm also including all the other similar type goods and services taxes. You know, in Canada, you have harmonized sales tax, provincial sales tax, and goods and services tax. They're all referring to essentially the same thing, but just on a state versus federal basis, and it goes by different names under different in different countries. But the value-added tax is more and more being applied to companies that have no sort of taxable presence in a jurisdiction, very much like Zach mentions around the Wayfair case and generating economic nexus. Foreign countries around the world have taken the position that value-added tax should be applied in a similar manner. And essentially what this means is that if you have a U.S. company that is selling e-services, and really that's anything over the internet, and we'll talk about tangible property in a minute, but let's just assume that it's a streaming service to a subscription to a dating site to who knows what, and it's delivered to an individual in France, for instance. France is basically saying that the place of supply of that service is that person's computer, and therefore that U.S. company needs to register for, collect, and remit value-added tax for that transaction. And really the reason why many countries have gone to this path is because it puts their local companies at a disadvantage, because their local company has to charge 20% VAT for the exact same thing if they're charging a French customer, whereas if the company was in the U.S., they did not have to charge that customer 20% VAT. So everybody went to the U.S. company to buy the service because it was 20% cheaper. Right now, there's approximately 60 countries around the world, plus the EU. So again, a very large number of countries that require a non-local entity to register for, collect, and remit VAT on those types of transactions. And literally we are spending, we're working with dozens of clients on this, because it is a huge exercise to go through all these countries. So, and all the requirements are different for registration. Some are as easy as spending 5 minutes on a website and registering for VAT and sending it in. The other ones requires a local tax representative. So all the rules are different by country, but it really involves, I mean, typically our first step in evaluating this is taking a look on sales by country and evaluating that against the thresholds for each country. Some countries, the threshold is 0. You owe tax beginning at the first dollar of revenue. Others are upwards of $50,000 to $60,000. I don't think there's any that are more than 100,000, but it's really evaluating that potential exposure. Many countries are going after this aggressively. Taiwan, for instance, has a whole team, a very large team of people that are evaluating any website that has a .tw on it for potential applicability of this tax. And we've had many of our customers get notices from Taiwan requesting them to register, even when the amount of the VAT was less than $1,000. The next kind of area, so very important, any company that is delivering any sort of service over the internet that is to any foreign jurisdiction should be evaluating these considerations. For transaction flow of product, there has been a lot of changes in certain jurisdictions with this as well, and in two main areas. One is around platforms that sell products. So again, I mentioned that many of these rules are set up to put the local vendor or local merchant on par with the non-local merchant. And one place we've seen this is the online sale of tangible property. So if you sell products to a consumer, a television set, for instance, to a consumer in Australia over the internet, you could be liable for collecting and remitting GST in Australia. They have rules that basically say that anything, I think it's over $10 and under $1,000 that's sold over the internet, you need to register for GST. Now there are thresholds to be considered, but again, this is something that has come out very recently for a number of these jurisdictions. And so just to kind of get back up, the companies to which this potentially applies is anyone who sells to individuals in foreign jurisdictions. You should really be evaluating your potential VAT considerations. The other piece around VAT, and that has to do with the VAT distance selling harmonization rules in the European Union, around how transaction flow works between the jurisdictions and who has to collect and remit, again, VAT on transactions for individuals as well as certain transactions between businesses. So VAT, again, very, very hot area when it comes to implications for non-resident companies. One other thing I just want to talk on briefly, and there's a number of jurisdictions that are implementing, I'll call it a digital services tax. India has this equalization levy, which in addition to requiring VAT to be charged and collected and remitted, is an additional digital services tax. 2% is the rate for sales to individuals, 6% if it's advertising revenues that are, again, applicable to non-residents that are selling to customers in India. And we're seeing this, like I say, in a number of jurisdictions. Turkey has also implemented a similar regime, just to kind of throw out another one. But the and that one's called the I believe the electronic services tax, I believe. But again, number of jurisdictions that are implementing that. So very important to, and basically what happens, what they do is if you do not register for, collect, or remit it, and you have a dot, I forget which India is, but a dot local website, they can close down the website, cause all sorts of problems if you don't pay it. So value-added tech. I saw we had a question on that, but it's so far down in the.
John, the question was on potential VAT issues when using a contract manufacturer in Europe. Do they have? Then they don't have a PE there. What does that situation look like?
Yeah, great question. Definitely are situations where if you have, for example, just to show the complexity of VAT transactions, if you have a U.S. company that has a contract manufacturer in the Netherlands, for instance, and they are selling it to a customer in Germany, or it doesn't leave the EU, the contract manufacturer, because it's not exporting the product, can charge VAT to the U.S. company, and then the U.S. company could be responsible for collecting and remitting VAT on a transaction with the customer, and again, unless it's being directly exported, even if the inventory is just sitting there, VAT can be collected on, or can be charged to the U.S. company by that Netherlands contract manufacturer. So it's very important to kind of analyze that structure and determine what options are available. In that situation, it's very possible that an exemption could be applied for. There's certain exemptions, and especially in import-export friendly jurisdictions such as Belgium and Netherlands, to either register the U.S. company for VAT as a worst case, or apply and get an exemption to avoid the inclusion of VAT in that transaction. But yeah, definitely something that that should be evaluated. I did get a question around FDII. Am I correct to assume that FDII does not apply if provided the service to a foreign resident while they're in the U.S.? Great question. To the extent that the beneficial use of that product or service is in the U.S., then FDII would typically not apply. If it's an actual product that, again, that the important part of FDII is that the beneficial use of that product is, or service is, going to be outside the U.S. So you'd have to determine if that foreign resident is going to, if they do use that service while in the U.S., then typically that would not qualify. But if they leave with it, if it's a product, then you could argue that it would qualify. Okay, last slide around international. So this is just kind of something that recently had some experience with, just given that there's been a number of situations where companies have, and this is kind of a little more of a departure from the other topics that we've touched on, but we've had a number of companies that have brought their intellectual property back to the U.S. From an offshore tax structure. Now, whether or not you decide to do that is definitely a intensive modeling exercise, and there's a lot of decisions around, you know, whether or not and why a company would do that. But there has been a number of situations where the accounting for those types of kind of transactions can be very complex, especially when you get a situation where you potentially would have a step up in tax basis, or a situation where you'd have whether or not you need to put up a deferred tax liability with respect to a transaction. So if you have, the reason why I just want to highlight this is if you have encountered or contemplating a restructuring that involves either check the box treatment of foreign subsidiaries as disregarded entities of the U.S. or anything similar, this pronouncement can be very applicable, and any such transaction should be analyzed to ensure that the accounting for such transactions is being taken into account.
Perfect. Thanks, John.
Anything else for perfect?
Nope, we're good. So I'm going to launch polling question number 7 here really quickly, just to give you some fun acronyms from the international side. So which of the following is not a type of international tax? GILTI, FDII, GTS, or VAT? Get those answers in. We'll close the polls in 3, 2, and 1. Perfect. All right, and now we are on to Pete.
Thanks, Debbie. So we're in the home stretch here, folks. A few more minutes to go. I'm going to talk about a number of different topics here, starting with Section 409A. So I think probably everyone's heard of this now. It's been around for 15 years or more. Section 409A is a lot more than just valuations. Section 409A really is a set of timing rules around deferred compensation that have to be followed, and if you don't follow those rules, then really bad stuff happens. So just as an example here, let's say you had $1 million of income that was part of a deferred comp plan, and the plan failed to meet the requirements of 409A for whatever reason, then regular income tax would immediately apply. So that could be as much as 50% or even more in some places. The penalty tax, if you will. They call it an additional tax of 20% for Fed applies for 409A purposes. California is the only state that has its own 409A penalties, 5%. And then there's this thing called the premium interest tax. So it's calculated like underpayment interest, but it's really a tax, so it's non-deductible. And in some places, what you can be left with is less than 10% of the total amount. In this case, that would be under $100,000 for $1 million deferred comp benefit. So pretty nasty stuff here. Next slide, please. And 409A is somewhat ubiquitous. It can apply to almost any type of compensation arrangement. Here's just some common examples of the things we see where it mostly applies. So stock-based compensation arrangements. Stock options can be carved out as long as the fair market value is equal to or greater than, the strike price is equal to or greater than fair market value. That's still an issue that some companies just can't get over. I also see a lot of plans coming from foreign sources, like the UK. I just had one from, believe it or not, the Czech Republic, where they granted them without regard to the US rules and ran afoul of this particular issue. Severance agreements are another big area, employment agreements, salary deferrals. Now we're seeing this a lot in the COVID world, where folks have agreed to take pay cuts, and the question of, does the company pay them back? Well, that can be deferred compensation depending on how and when that money is repaid to them. So you need to be super careful around that. And then annual bonuses and other long-term incentives are probably the biggest area right now. This is something to consider for year end, that if you have an annual bonus plan that's going to pay out in the following year, and that plan is either not in writing, or if it's in writing and doesn't contain provisions as to when the payment is going to be made, then that payment has to be made within 2.5 months of the end of the fiscal year. So if you're a calendar fiscal year, that's March 15th. If you pay it after that date, then you probably run afoul of 409A and the penalties apply. So just keep that in mind. Next slide, please. Oh,
Okay.
one question.
One question here, Pete. I'll give you a breath. So quick, get those answers in. Again, the correct answer doesn't matter so much as just get an answer in there for tracking purposes. We'll close the polls in 3, 2, and 1. If for some reason you're not seeing the question or it's not coming up, just do send a note in the chat box and we'll make sure that is captured for you. Perfect. There you go.
Okay, so jumping to 162M. So remember, 162M is the limitation on the corporate tax deduction relating to compensation for covered employees in excess of $1 million per year. So the Tax Cuts and Jobs Act dramatically changed the face of 162M going forward here. The group of covered employees used to be very limited. Now it's almost all inclusive of executive officers, including the CEO, CFO, and the 3 highest paid officers. And now once you fall into that group in any calendar year, any fiscal year, you are now a covered employee for life with respect to that company. So any payments that you get, no matter when you get them, even after you leave, are subject to the deduction limitation. So this has become now a tracking exercise for a lot of companies. The performance-based pay exception has been eliminated. There are still some plans out there that we see that are grandfathered under these rules, where if the plan and the grants existed prior to November 2nd, and they haven't been modified since then they can still qualify under the performance-based pay rules. Now remember that pre-Tax Cuts Jobs Act changes, there was always that question of, are your performance-based plans truly performance-based for 162M purposes? So those rules still apply to grandfathered amounts. And in a lot of cases, when we did those analyses in prior years, companies failed them for various reasons. So don't just take it as a given that your grandfathered plans are exempt from 162M. You still need to do that analysis. Next slide, please. Just a quick rundown of before and after. So you had performance-based pay before, now you don't. Covered employees were limited. The CFO was not a covered employee. Now the CFO is, as well as I mentioned, anyone that becomes a covered employee in any fiscal year going forward. The definition of when a company becomes subject to this used to be publicly traded equity securities. Now they've expanded that to include any type of security that has to be registered with the SEC, including debt securities, as well as some types of foreign companies. Next slide, please.
All right, quick polling question. Pete just went over this. The TCJA changed 162M compliance by, select your answer. Those answers in. We'll close the polls in 3, 2, and 1. Perfect. There you go.
Okay. Jumping on to fringe benefits. So there's been a lot of activity in this area recently. One of the things that's pretty hot in the Bay Area anyway is meals at the convenience of an employer. So think of companies that, buy their employees a free lunch every day in their office so they don't have to leave. The IRS has been on the audit trail on this pretty significantly. A lot of companies have fallen victim to this where, if you're based in an area where there's lots and lots of places to eat lunch for your employees, then generally speaking, you're not going to pass this rule. In which case, if you've been giving free lunches to employees, then that's going to be imputed income to them, and there can be substantial liabilities for prior years. And that can become an accounting issue as well, where companies would be forced to put up reserves for that. So even the financial statement auditors are on the trail on this one. So, it really lends itself to an analysis as to whether you think you qualify for this before you start doing that. Just a reminder that as we get toward year end, holiday gifts, if they are property, not cash, and they are de minimis in value, then they can be excluded as compensation. Anytime it's cash, no matter how much that is, cannot be excluded. Qualified transportation expenses, so we saw changes in the Tax Cuts and Jobs Act around this, basically eliminating the deduction for employers for these expenses, still tax-free to employees, however. So there's some analysis there. Things like parking spots require some analysis around whether that's includable or not. And then this one is probably the most asked question in the last couple of months is, well, hey, we're all working from home now. We set up our employees with home internet, with office equipment, with cell phones and other devices. Can we exclude those as compensation to them? And we've seen a lot of companies going after what's called the 139 disaster relief exclusion for that. I'm not a big fan of that. If you have an accountable plan, which means your expense reimbursement plan's in writing and you do proper substantiation, most of these expenses can be deducted by the company, excluded as income to the employees. And then don't forget about personal use of things like company aircraft, cars, other facilities. Those generally are taxable to the employee, and if not extravagant, then deductible by the company because it was compensation paid to the employee. Next slide, please. Again, here we see this very often where the companies either don't include these amounts or underestimate the value, and that can lead to penalties for failure to properly report, withhold. I just had a client where they didn't report these amounts on numerous W-2s and 1099s, and the IRS caught them and enforced what's called the 6721 penalty, which is about a $500 penalty per form that was not done correctly. And that can add up in a big hurry depending on how many folks you have. Other fringe benefits deductible to the employer. So remember that business gifts generally are not deductible. Club memberships, so health clubs, that sort of thing, are not. And qualified transportation, again, changes in the Tax Act of 17 that eliminated that for the time being anyway. Next slide, please. So worker classification is something that's been around for a long time now. We saw this really come to a head when Obama was first elected. This was one of the big issues at IRS. It was a tier 1 before they did away with tiering. But now we have a little bit of a twist on this, particularly in California and some other states that are looking to enact similar laws as to what California did. So California enacted this rule called AB 5, Assembly Bill 5, where, aimed mostly at gig workers. So, think Uber, Lyft, that sort of thing. Where under this rule now, these companies have to treat those folks as employees, not independent contractors. Now that's being fought in the courts by Uber and Lyft and other companies. There are exceptions or exclusions for numerous different types of businesses. And now we have Prop 22, which is on the bill for November. A yes on Prop 22 would eliminate AB 5 entirely. So we'll have to see what happens there, but this is still a big issue for a lot of companies. Just how do we deal with, this rule? Does it apply at the federal level or only the state level? Should we be treating them as W-2 employees for state, but 1099 for Fed? All kinds of questions come around on this one. And then don't forget, we still have the federal rules out there. So the IRS, their 20-point tests, as well as other court cases to, classify these workers. Misclassification can be very, very bad news. There's been a number of cases, high-profile cases, that have resulted in millions and millions of dollars of penalties. And there's many other things that impact this as well. Next slide, please. So qualified small business stock, remember this came about years ago. If you acquired stock of a qualified small business in 2010 or later, you can get a 100% exclusion from capital gains if you meet these requirements. So 5-year holding period, the stock must be acquired directly from the company. It can't be acquired from another investor that already owned the stock. The corporation has to be a C corporation, and then there's a number of rules that apply as far as whether that's a qualified small business. We've seen a lot of activity in this lately. The big question for a lot of companies is, when did I cease to qualify as a small business? And therefore, stock that was acquired after that date doesn't qualify under this rule, and that's really the tough part here. Next slide, please.
That's the end of it, Pete. Do you have any kind of closing comments before I jump to the final polling question?
I thought there was one more slide. No?
Oh. Did I lie? Nope. That's it.
The secondary sales, did that not get in there?
Oh, I'm sorry. Hold the thought. My goodness, it's been a long day for me.
That's all right. I can just talk about it before we do the last polling question, I guess.
Yes,
so
go for it, and I'll jump back.
Oh, there we go. So secondary sales. So this is probably, I'd say every technology company client we have is doing these. They're everywhere. Basically what this is the company's private, and they're able to now find investors that are willing to buy common stock from employees, founders, former employees, et cetera, for generally a price that's well in excess of the company's 498 valuation, which, remember, is supposed to set the fair market value of the common stock. These transactions, depending on how they're structured, every single one of them can be different. And you really have to look at all the facts and circumstances. Worst case scenario is you do one of these transactions and your facts call for additional payments of wages around this on the difference between the 498 valuation and the purchase price. And you find that out well after the fact, after the end of the calendar year in which the transaction was done. And there's not a lot you can do to correct those things. This can also give rise to accounting charges. reporting and withholding failures, as I mentioned before, can be a big issue. And then even things like your next 409A valuation may be skewed because it didn't take into consideration these transactions. And so you have to be very, very careful with that as well. Now let's do our last polling question here.
Perfect. Thank you. All right. Last question, tied to the qualified small business stock. Get those answers in. And we'll close the polls in 3, 2, and 1.
Wow, Debbie, right on time. That's amazing. So this is David again. I just wanted to thank you guys all very, very much for hanging in there. I know there was a lot of content there. Hopefully it was helpful. We do plan to do additional events as things are rolling out, and as we anticipate as I kind of started off this call. So thanks everybody, and let any of our panelists or me know if you have any questions that you want us to follow up on. We'd be happy to talk to you.
Thanks everyone. Have a great rest of your day.
Thanks everyone.